So the financial news this morning is all looking forward to tomorrow, where they're going to be releasing the latest inflation print, and there's all the usual talking heads are out there saying how some are saying, oh, inflation is moderating, and it's a great word, moderating, and others are saying, well, inflation is re-accelerating, and they're all making their predictions. What was more interesting to me was that the IRS released their brackets. I think it was Thursday of last week, something like that. So they, every year there's adjustments based on the code, as far as how bracket cutoffs and the standard deductions and all these kinds of things change. So I went in and I took a look at the revenue procedure. It was, so I think 2023-34, if I remember right. And I took a look at it, and basically the numbers went up by 5.5%. So like standard deduction, if you were married filing joint, went from 27,700 to 29,200. And so, and then the rates, or the numbers at which the brackets go up, all increased, by roughly 5.5%. But so I, when you hear that, it sounds like that, if you make the same income in 2024 as you do in 2023, that your taxes are going to be 5.5% lower, because if the brackets are increased and the standard deductions increased, then for an equivalent income, your taxes are going to go down. They do go down, but it's not 5.5%. So I built a little quiz tool that steps you through the 4 questions, really. What's your income, what's your filing status, what's dependents, 2 different dependents, because there's 2 different categories, under 16 and over 16, and then it goes through and it calculates what your tax load is, and it steps through the brackets. So it's a huge exercise in frustration for me, just because I wanted to get something that worked, and the tools I was using the data ended up overloading the tools, because it's highly conditional with all those different 4 degrees of freedom, basically. So anyway, I built the tool, and it took me many hours, and I started playing around with it. So what was interesting was that the actual, for a given amount of income, the actual tax savings was about 1.7%. It depends on where you fall in your bracket, because if you're closer to a cutoff on the low end, then you have more at the lower rate. If you're higher within the bracket, then you have more at the higher rate. And which bracket you're in matters, because they're different widths. So one bracket might go from 0, like if you're single, the 2024 bracket for 10% goes from 0 to 11,600. So the width of that bracket is only $11,600, and then after you get to some higher brackets, the width might be $200,000. So they vary greatly. And so yeah, as I was playing around with kind of like what I would call normal-ish numbers, kind of numbers we see a lot as far as household income, then the actual savings is 1.5% ish. And I had to think this through. It's like, well, if the brackets went up and the standard deduction went up, it's like, well, what's going on? It's like, and I realized that it's very nonlinear. And the fact that the deduction went up actually reduces the impact of the brackets going up. So it's there's multiple dependencies, and it's not linear. So that was kind of the thing there. So effectively, what that's saying is, for IRS purposes at least, then the inflation adjustment for 2024, or covering 2023 going into 2024, is 1.5%. So we know that inflation, according to CPI measures, has been well over that for the entire year. And the way CPI gets reported is that they report an annual rate. So if inflation comes in at 7%, in a month like it did, back in the summer, that's not saying that that month was 7%. They're saying that month annualized over the whole year was 7%. And they report year over year numbers, they report month over month numbers, and they different versions of that are used for different purposes. But yeah, it's never been 1.5%. None of the numbers in the last 18 months, something like that, have been under 1.5%. For a long time. Since the '08 crash, really, that people have been worrying about how do we increase inflation, because they have this flawed economic theory that inflation is a good thing. But nonetheless, your taxes are going up because the adjustments that they made do not create equivalency between this past year and this upcoming year. Again, by the government's own numbers. So, on a purchasing power basis, which we're trying to, we were talking about measuring sticks the other day. Purchasing power parity is an attempt to normalize your measuring stick. And this, is just one of many problems with our our monetary system, that there is no measuring stick that's consistent. I mean, you can make the argument that there are no measuring sticks that are consistent anywhere for anything, but there's definitely relative consistency compared to others. The universe itself is expanding. Okay, but in our local environment, it's steady enough for our purposes, our macro purposes. So yeah, on an inflation-adjusted basis, taxes are going up, even if the amounts are being adjusted downward, and that's just because as people increase their incomes due to inflation rather than due to productivity gains, then the tax rate is not offsetting that in a sufficient way. So, that's a fun thought for the morning. But, there are ways to protect yourself from inflation, and there are ways to benefit from inflation. I mean, the core element, got something crawling around over here. The core element is, the way things are structured is inflation benefits assets. So, there's obviously everything is there's a squirrel. Squirrel! Everything has its own ups and downs, for its own supply and demand, like we're seeing with housing right now. Housing benefited hugely from the inflation over the past couple of years, and now it's starting to correct. Different markets are different, but by and large, with the higher interest rates, people can't afford to buy higher priced homes, because the increase in the monthly payment, for a given, pick a number, 20% down payment, 3.5% down payment, whatever, has outpaced people's increase in nominal earnings. So, the affordability has gotten worse, and you can look at plenty of charts and people talking about that on YouTube. So, housing's in for a rough patch here, I think. But overall, inflation benefits assets. Any kind of, especially anything that is financialized, that's subject to heavy lending. Because the lending is how new money is created. And so, Cantillon effects go to the people who receive the money first. New money is created through loans. People receiving the loans to buy, buy businesses, buy houses, buy stocks, all that kind of stuff are benefiting at the expense of everybody else. So yeah, it's that's probably the easiest way to protect yourself from inflation. Uh, you know, I talk with some people about IBC, which is the infinite banking concept. This is the idea that was developed to use whole life insurance policies that are structured in a particular way to build up cash value quickly. And so, like, I use these, and people have criticized the concept and say, well, it's your return on your investment is super low, and all this kind of stuff is, it's entirely missing the point. The point of a policy, and this, you don't have to do it with life insurance. You can do it with other things, but life insurance is just the most efficient, and it's because it's not an investment at all. It's a savings vehicle, and the savings vehicle is preferential, and it's better because it inflation protects your savings. So, what do insurance companies do? They lend on real estate and they buy bonds. That's pretty much it. And they're fairly heavily regulated by the states, for capitalization ratios, that kind of thing. But you have to look at your individual finances in terms of the way I look at it is in 3 tiers. There's like a base tier, this is like basic security. There's a mid tier, this is relatively low risk, kind of things, and then you have a high tier, high risk, high reward kind of situation. And there's different approaches to how much of each thing to have. I'm more interested in kind of like a barbell strategy, where you have a lot of safe, secure stuff, you got a good amount of high risk stuff, and in the middle, not much. Just because the relatively low return, low risk just doesn't move the needle that much. I mean, if you do it enough over long enough time, then it works out. But I've been much more interested in high potential outcomes. So highly volatile assets, like crypto, and your own business is going to be your highest leverage point. But on the safe level, savings fundamentally, and when you put money into an IBC policy, that money is being deployed into these kind of bonds and real estate loan sort of things. So what that does is that keeps pace with inflation. We've seen the bond markets rise from point something percent up to 5.5%, roughly. And that it's not perfect, but it does roughly keep pace over time with the inflation. So if I put in $1,000 today, then over time that $1,000 buying power is going to be preserved through this policy because of that investment matrix. And it's superior to just buying bonds, in my opinion, simply because it preserves liquidity. Once you get over the first couple of years of the policy that has a drag on it, they're paying commissions and stuff. But once you get in 3-4 years typically, then you're break even cash on cash, and then you start to keep pace, and then eventually outpace inflation as the efficiency increases. But that takes a long time. So so it's just that base tier of savings, and I can afford to save more because that savings is inflation protected. And if you just keep your money in the mattress or in the bank, earning 0.1% interest still, you're losing to inflation. So it's just a way to store capital and not lose out over time, and that allows you to be more mindful about those opportunities that you pick. I've said it many times that you really only have to be right once in life financially. You might also want to be right once in life, romantically. Divorces are incredibly expensive, and I recommend not getting them. But if you pick the right partner, it's life is easier and better. So so if you have your base level, and you're just stacking cash, and that cash isn't being eroded by inflation, then the 8% in the stock market is not nearly as attractive. When you can wait and pick your spot and say, okay, this business, with my skills, my experience, my personality, makes a whole lot of sense, and I can turn this into something really profitable. You have that flexibility. You can just wait. If you're a trader of some kind, whether it's stocks or bonds or crypto or gold or collectible coins, or just people trade all kinds of stuff, then you have the flexibility just to wait, and wait for the opportunity that is has a great risk reward to you. And everybody's gonna be different. My buddy Mitch talks about how he's a trader, and he talks about how you have to find the trading style that fits your personality, which I totally agree with. Many years ago, the reason I got into tax trouble originally, actually, was because I was day trading, and I got into it because it's like I don't want a job, and there's a whole story as to why I didn't want a job. But so I got into day trading. I had a little cash, and I realized after going through the whole experience, it's like, well, I didn't want a job, so I gave myself the worst possible job I could find. I was at my desk, glued to the screen from 8:30 to when did the post market close at the time? I think it was 5 or 5:30, something like that. ARCA had just been developed, and afraid to go to the bathroom in case I'd miss something. It was insanity. Yeah, definitely not a fit with my personality. I'm just stress. It's just terrible. And and I ended up losing money overall, just in case you're wondering. So I would, like, on a daily basis, I would make money, but then there would be like 2 or 3 spectacular losing trades that I would get stuck in. I remember at the time I was trading a lot on the over-the-counter market, OTCBB, which I think doesn't exist anymore. But the market makers on the over-the-counter market don't have to fill your orders, like, at all. So I got stuck in positions where, like, I had orders I was trying to sell at the bid, and they just wouldn't fill. I was trying to sell below the bid, wouldn't fill. And that's just because the market makers were, had their own positions and didn't want to execute that trade. And there's no recourse. There was another situation where I was using Ameritrade. This is before the TD bought them, and they had like a day trader kind of platform, and the internet went out. Not my internet, their internet went out, and nobody could do anything. And I ended up stuck in a bad trade. And during times of high volatility, when you want to trade the most, that's when they had outages. So that was a problem. But yeah, that was not a fit for my personality. And over time I got into more swing trading and options trading and stuff like that take more relaxed, longer time period. Instead of a trade of a couple minutes, it would be a trade of a couple weeks. So that just fit better for me. And once I started doing that, I was a lot more successful. Yeah, it's so critical to have your plan, that makes sense in the environment, taking into account inflation, makes sense to you personally, within the context of your base, middle, and high risk tiers, and makes sense with your personality. So that's my thought for today. See you guys next time.